Now let's go into the real meat and potatoes. Let's talk about life insurance. Now remember that a life insurance policy, with these life insurance policies, we can divide them into groups. The cash value policies or the permanent policies, and the term policies or the temporary policies. And the difference is what? Term insurance has what, everybody?
No cash value.
One more time. Term insurance has what, everybody?
No cash value.
No cash value. So that means that if you see a question on the test about anything, and it says blankety blank, except, and one of those answers start talking about term insurance and anything to do with cash value, that would mean what? That would mean somebody, it's both the policy owner and the insured, receiving some money from the policy in any way, shape, or form. Remember that with a term policy, does the owner of the policy get any money out of the policy? The answer is no. The money's for your what? For your beneficiary, right? So if they talk about the policy owner or insured getting some money, if they talk about the policy endowing or maturing, they talk about the policy having a loan, they talk about the policy having non-forfeiture options or dividend options, they talk about the policy being paid up, any of those things, that answer would be false, because what? What allows those things to happen is the fact that the policies have cash value, and a term policy doesn't have that, so it can't have any of those things. But that's really kind of the question you're going to get on term insurance, because what? Because the policies are so simple, there's not a lot else they can ask about that. And remember, our big trade-off here is what? The policy has a much, much lower premium, sometimes 8 to 10 times the less than the original policy. In other words, if you have X amount of coverage with a term policy, to get that same face amount with a whole life or a cash value policy, it might be 8 to 10 times as much. If I'm paying $100 a month for my term policy, to get that same face amount, I might pay $800 to $1,000 a month. That's a big difference. Got it? Okay. Now, 3 types of term insurance: level face amount, and level premium for the entire length of time, which sort of means we're kind of averaging the cost of the premium over time. Because what? As you get older, the coverage gets more expensive. But we're kind of averaging that over that length of time. And also remember that what? If the person dies one day after the end of that policy term and they didn't renew, how much does the policy pay out? Absolutely nothing. And that is risk pooling. That is risk pooling. Because what? Because a lot of people do that. Strangely, people cancel the policy. Well, I say strangely, right? I canceled my term policy because I got to an age where my son was grown and gone, and I no longer needed the coverage. Because once again, what's the purpose of a life insurance policy? It's
Give you peace of mind.
give you peace of mind that if you pass away, then your family is going to be okay financially. Well, now I have assets. So if something happened to me, then my family would then get my assets. I don't need to make up artificial assets with a life insurance policy. But when I was young, I didn't have the amount of money that I have in the bank now. I didn't have the amount of equity in my home that I have now. I didn't have the amount of savings that I have now. And so because of that, there was no money to give to my family. So I had to create that with the term life insurance policy. Now, with a cash value policy, it's a little bit different because the policy has other reasons to have the policy other than just to provide coverage or some money there for my family if I was to die early on. But at the end of the day, if somebody does have a policy, like I did, and they didn't die, then what? That premium went to what? The handful of people that did die. That's risk pooling, and that keeps the premiums low for everybody. If you had $100,000 face amount of your policy, you would not want to have to pay $100,000 in premium, right? Does it make sense? All right, and then we have decreasing term. Now with decreasing term, the face amount is what? The face amount is going down over time. Does it make sense, everybody? So with a decreasing term policy, the face amount is what? Decreasing. But what's happening to the premium, everybody?
Stays level.
The premium stays level. Premium stays level. And what does that mean? That means that what? Over a long period of time, we're balancing out the fact that as you get older, the insurance gets more expensive, but you're getting what? Less and less insurance. So those two can balance each other out so that we can keep the premium level for a long period of time. And what do we use decreasing term for? To cover a debt like a mortgage or to cover the tuition for a child in college. All right, then we have increasing term. Now remember, increasing term, remember the face amount of a whole life policy. Can the face amount of a whole life policy change over time, everybody? So if we need the face amount to go up, if we need the face amount to go up, then we have to what? If we need the face amount to go up with a whole life policy, what we have to do is we have to add on a what? A increasing term policy for the return of premium rider or the cost of living rider. The way we do that is by adding on increasing term. And then finally with term insurance, in order to, at the end of the policy, if you want to renew the policy, you're going to get the option to renew. Now, as I mentioned, this is included with almost every term policy out there. So we think of these as temporary policies, but in fact, you can keep them going typically for as long as you'd like by what? By renewing. And when you renew, you go from what? Term to term. And you're essentially renewing the contract. So if the policy was for 5 years of $100,000 of term insurance, when you renew, you're going to get a what? Another 5 years and another $100,000. The length of time, the term, and the amount of coverage is not going to change. But what is going to change is the what? The premiums. The premiums are going to be higher because the client is older. But remember also, and another way, the insurance speak for the client is older is that the premiums are based on the client's now attained age, the age they are now. But remember, this really only has to do with insurability. Meaning what? If you're perfectly healthy and you get to the end of your policy, are you going to renew? The answer is probably not. Because you're going to what? Because you're probably going to just go out and shop for something that's less expensive. However, if there's something wrong with your health, something has changed, then you're going to need to renew. And the good news is the policy will let you do that. But it's going to be expensive because you're older. Make sense? All right. So, option to renew, face amount and the length of time is going to be the same. It only has to do with insurability, which means you're only going to do it if there's a health issue. Now, we also have option to convert. Now, with option to convert, here we're going from term to whole life. Now, this is early on in the policy, first 5 years, the first 10 years of the policy, whereas option to renew is going to happen at the very end of that policy. But this gives you the chance to what? Go from term to whole life without, once again, insurability, without having to take a medical test. Okay? All right, that's term insurance. Any questions about term insurance? Everybody comfortable with term insurance? Fabulous.